What is up, everyone? Michael Manoskanian here for another, I don't know what to call this, my live office hours. That's what we call this. This is my live office hours. I do weekly every single Wednesday at noon p.m. PST. Sounds weird. 12 p.m. PST. I do these live office hours. And basically what I'm here to do is answer your questions, whatever questions you guys have. A lot of people pre-submit questions, which I appreciate, makes it a little bit easier. I also help with live deal analysis, or I'll host whatever trainings I feel like is relevant at the time. But that's kind of the main three things: answer your questions, help you analyze deals. And then if there's a specific topic or training or something I want to highlight, that is what I will do. Just as a quick reminder, I am Michael Manoskanian. I am a real estate investor who has over $22 million of real estate. I bought my first property less than 5 years ago. So next month is going to be my 5 years. So May, like the last week of May, is going to be my 5-year mark since buying my very first property. And then before that, I had 18 months of learning and analyzing deals and taking action on spreadsheets, but not necessarily taking action the way that, buying deals. And so I talk a lot about that as well, sharing that journey. In addition to being a real estate investor, I'm a capital raiser. So I've been able to fund all of my deals either through the bank's financing, the seller's financing, or with my capital partners. So we are co-owning these properties, or they're private money lenders. Just depends on the scenario. I'll be over $22 million portfolio, as we have 4 properties right now, 4 Texas CoLiving properties. So we 30 new CoLiving rentals added to the portfolio. Just got the capital raised on fractional, so people are able to own with us for as little as $5,000. They are going to be an owner in this portfolio of properties, and they get to leverage that for their own credibility. They get the cash flow benefits. They get ownership benefits like debt pay down, appreciation, tax benefits, all that good stuff. But more importantly, as an owner, they can leverage that as part of their credibility for when they're buying and holding more deals, or when they're raising money for their deals. So collectively, over 70 properties, over 100 plus units, worth over $22 million. The portfolio, not me. The portfolio is worth that. And I've raised around $5 million to be able to basically acquire this whole portfolio. So with all that being said, I provide tons of free education. In addition to these live calls, I have a free school community called Wealth Through Real Estate. I will drop the link for anyone who is not part of it, but I provide trainings, and I'm adding a lot more to it soon. I'll drop it right here. Basically, there's a bunch of trainings on how do you actually achieve financial freedom through real estate investing? Like as a lender, as a buyer, even through the stock market, like how do you actually achieve financial freedom? I think we all say this is something we want to do, but you don't actually know how. Well, that's what I want to help you guys figure out, is how do you actually do that? I provide a budget and financial freedom tracker, all this good stuff. Actually, why am I talking about it? Why don't I just show it? Let me screen share. So please ignore all the mismatch and discoloration of all this. I'm revamping everything in the free Wealth Through Real Estate community, the one I dropped the link for, and it's actually listed here. I'll have an even shorter, easier URL in the very near future for you guys to be able to get there. Also, if you go to my website, Michael MNAT, if you go to Michael MNAT, you click this link, this will also take you to Wealth Through Real Estate so you can join. We have 1,100 members, and this is growing pretty steadily and pretty quickly. But I provide tons of trainings. So Financial Freedom Blueprint, how do you actually become financially free through real estate or in general? I provide a variety of spreadsheets in regards to a budget and financial freedom tracker here. So you can actually track your budget, understand what is your progress towards financial freedom, what's your net worth, all that good stuff. And then I provide free creative finance real estate investing calculators in here, as well as this thing that I'm going to be talking about today, which is the creative deal analysis checklist. A lot of the questions I got was about deal analysis this week and why I love to buy deals from wholesalers. So that will be one of the questions I'll be answering. Just want to show off the Wealth Through Real Estate community, totally free for you to sign up. There's analyzing deals, whether you're buying traditionally or creatively. I have a series in there for co-living. And then I'm going to have a even cooler series in there for another co-living series in here. And then a bunch of more free resources, bird dogging, all this good stuff. So there's going to be even more. I'm revamping all of this free education and the tools that are included in there. That's why it looks kind of crazy right now. But you're more than welcome to join absolutely free. All right, so let's see. In addition to that, I have my super investors community. This is a paid community. This is for real estate investors that are looking to leverage creative financing, capital raising, co-living, all of these advanced strategies that has allowed me to become financially free much more quickly and efficiently. It's what I call the path of least resistance to financial freedom through real estate investing. In essence, it's how do you yes, maybe some of you guys want to own hundreds of properties for the sake of it. In my opinion, it's better to be financially free. Get the cash flow you want passively coming in each and every month that exceeds all of your expenses, right? That is financial freedom. Do that faster and easier. I think that is the most logical thing. You want to get there as quickly as possible, as efficiently as possible, not do it the long, hard way. And that's really what this community is all about. We specialize in, once again, financial freedom, the foundations here, mastering deal analysis, how to consistently generate leads. And a big part of my strategy is buying deals from wholesalers. We'll be talking a lot about that today. The property acquisition blueprint, my step-by-step guide on exactly how you, A to Z, how do you get from your leads coming in all the way to closing, owning, and operate your business, as well as how you're going to scale your team, who you hire, when it makes sense to hire people, mastering capital raising. So this is no fluff. This is 4 intense training series all about capital raising. How do you analyze deals with capital partners? All that good stuff. How do you actually build those relationships? How do you present these tools, and how do you present all this stuff to them? Like, how do you actually have these calls, and what do the scripts look like? How do you leverage the Super Investor CRM that I give you? How do you leverage that to be able to raise capital more effectively? Since I'm raising a lot of money on fractional recently, we've raised over almost $1.5 million in 2 capital raises, and literally within days on the platform. This was 2 months apart, but within days on the platform, I built a whole training series for all of my super investors for them to join or for them to leverage. And then I provide all my scripts, my slide decks, whether it's private money lenders, private money partner, whatever. I try to make it as easy as possible for you guys to succeed. Plus SOPs, operations, all that good stuff in here as well. So if you are someone who is a real estate investor looking to take it to the next level, you're looking to go from traditional to creative deals, looking to start buying deals from wholesalers, learning to master capital raising, learning to be able to structure great deals, co-living, raise capital, all that stuff, that is what Super Investors is for. I have to interview you if you're interested in joining. So you have to reach out to me directly and let me know you're interested in Super Investors. We'll talk and see if it's the right fit. Otherwise, I will more than likely say maybe Wealth to Real Estate is the right community for right now for where you're at. So that being said, let's get to the questions for today. I will quickly go over the 4 questions. I will stop screen sharing. I will go over the 4 questions. So what we're going to be talking about today is, why do I prefer buying deals from wholesalers instead of going directly to sellers and agents? Great question. What is the minimum cash flow I need to buy a deal? Can I break down my entry fees for buying an investment? Am I just covering the acquisition costs or the renovations, or what else is included in there? Another great question. And then what is my rule of thumb for a wholesaler assignment fee? So basically, what am I willing to pay a wholesaler based on the returns I can expect on a deal? And they said they've heard of $1,000 for every $100 of rental income that you get. There's a $1,000 assignment fee. I think that question's a little off. Usually it's whatever. I'll get into it in detail then. So let's start with the very first question. Why do I prefer buying deals from wholesalers instead of going directly to sellers or agents? So this is a great question. And as someone, me, who has wholesaled almost, easily over 100 deals, the majority of them being cash and then some being creative, I learned that if you are a cash wholesaler, there is a massive amount. There's like a large assignment fee that you can generate. For creative deals, for the most part, there's not a huge assignment fee that you can generate, but you are spending a lot of time talking to, let's say you're trying to get a creative deal under contract. Well, you have to pull a list of people, right? You have to have a motivated list of people that you're going to target, skip trace that list. So get all of their contact information, put them in your CRM, reach out to them. For every 100 that you talk to, maybe 10 would be potentially interested in that. And then for those 10, maybe you'll put less than 5 of those under contract, and that'd be a pretty freaking high success rate. And you're going to put maybe less than 5 of those under contract. So at this point, you have spent a bunch of time, money, and energy to potentially generate up to 5 deals, put them under contract, and they may not be great fit for your overall buy box. So in my opinion, my time is much better spent connecting with wholesalers who are already putting these deals under contract, and for me to identify, is this a great deal for me? Or maybe the deal that they put under contract is not, but I, as a super investor, can identify, hey, if I was able to tweak this seller finance interest rate, or if we're able to drop the entry cost by X amount of dollars, this would be a good deal for me. My time is better spent identifying what are good deals from other people, right? They put it under contract. My job is then to say, is this a good deal for me, or should I renegotiate it? And then raising money, right? You guys hear, I mean, I've raised millions of dollars to build my portfolio. There's no better cheat code in real estate investing than leverage. And leverage comes from through the banks, through the sellers, or through capital partners where you're providing them these investment opportunities. We're leveraging their capital to grow your investment portfolio. Yes, they get solid investment returns or ownership benefits, but it's also benefiting me because if I'm putting little to none of my own money, my returns are extremely high or infinite. So my time is better spent instead of trying to talk to hundreds of potentially motivated sellers, finding the few that are actually motivated and then putting them under contract. My job is to look at deals that other people have already put under contract, buy them as is, or renegotiate them, and then raise money to buy my deals. So once again, the best use of my time to scale a portfolio is to find great deals, raise money for those deals, not to talk to hundreds of potentially motivated sellers to then potentially put a few properties under contract. And that's not really scalable. Yes, some people are specialized in pay-per-click or pay-per-leads, or, they're working in multiple markets, or you can very hyper target a market. But if you are open to a variety of markets like I am, and you are looking just to find great deals efficiently, you can do your own direct acquisition. I've done plenty of direct acquisitions for my own portfolio, but the majority of the deals that I buy and have been buying for the last 2 years, which have allowed me to scale, are by spending my time and energy buying deals from other people. They're doing all the work. I am more than happy to pay them their $5,000, $10,000, $15,000 assignment fee for them doing all of that work. And because what a wholesaler is doing is they're putting in their time, money, and energy to potentially have a property under contract to then be able to sell to someone, and that is when they get paid. Well, when I am just focused on buying deals instead of going directly to sellers or agents, I'm not spending any money. Yes, I'm spending time and energy on analyzing these deals, or I'm not spending any money until the closing date. I put a little bit of money down for earnest money deposit, right, to put the property under contract. However, the first time I'm actually spending money is when I'm closing, and that is my capital partner putting the money in to cover their costs. So what I mean to say is it's less risk in the sense of I'm not spending all this time, money, and energy to potentially get a deal and then potentially make money from that. I am making my money, or the first time I'm really spending money is when we're actually closing on that property, buying that property, right? That is when we're spending our money. That is when we're paying the wholesaler. So a wholesaler is putting a lot of time, money, and energy to potentially sell a contract to make $10,000, where my time and energy is primarily spent once I identify a deal and I'm closing on it, I'm owning on it, and then that is then funded by my capital partners, whether it's a private money lender, private money partner. They're the ones funding that, and I haven't had to invest any money up until that point to decide if I want to buy a deal. That's one big reason. I don't think your time, money, and energy is best spent. If you're a buyer, if you're a true buyer, I don't think it's best spent trying to put deals under contract where you can just try to identify deals that make sense for you to buy and raise money. I think that is a better use of your time. That's one thing, right? Secondarily, I don't like the urgency and time demand required from wholesaling. For example, you can be talking to a wholesaler, it's happened plenty of time, or you can be talking to a motivated seller, it's happened to me plenty of times, and maybe someone else, maybe they try to call you and you're not able to answer that call because you have something else going on, or someone else calls them at the perfect time, and they end up, even though you've talked to them, 5 times, 7 times, you built this relationship, they're motivated, but now because the other person hit them at the exact time, or you missed their call, they may not be willing to work with you anymore. I don't like to work on other people's timelines, other people's schedules on their urgency, where they needed this done at this moment. If you didn't, then it doesn't make sense for them anymore. I don't like to work on other people's timeline. I don't think it's not conducive to the way that I like to operate. It's not conducive to my lifestyle. For some, awesome, do that. That's your job. That's your job. You're going to make this your active income source. You are going to be working on other people's timelines. For me, that's never something that I wanted to do or be part of. So that's another reason my wholesaling as a whole never made sense for me. Even though I was doing it, it didn't make a lot of sense for me compared to just being a buy and hold real estate investor. Ironically enough, I started as a buy and hold real estate investor, then became a wholesaler, and then I had to just stop wholesaling so I could just quadruple down on buying deals. And for a lot of you have seen the journey, you've seen how much I've been able to scale by just focusing on finding deals from that other people put under contract and raising money to buy those deals. You've seen the scalability of that as opposed to trying to do all of it. So I prefer buying deals from wholesalers that are going direct to sellers or agents because I think that it's a better use of my time, money, and energy to buy deals from other people and raise money than it is to go direct to agents and sellers. Secondarily, if you are working with sellers and agents directly, a lot of the time it's an urgency thing. Like if you're spending all this time, money, and energy to then get this motivated seller who's now open to selling, but unless you're available exactly when they need you to, they sign the contract, everything is done, like in their time frame, then it more than likely someone else is going to get it because we're all kind of hitting the same lists. So I don't like working on other people's timeline. That's another big one. The worst case scenario, if a wholesaler has a phenomenal deal and I underwrite it and I'm not able to make an offer right away, or I don't underwrite it fast enough, okay, someone else bought that deal, whatever. Like there's no money lost in that scenario. I've developed my skill sets further. I've analyzed another deal. I know this wholesaler puts good deals under contract. I need to perform quicker, but the worst case scenario is I don't buy that deal, whatever. That is way better of a downside risk than spending time, money, and energy trying to get a motivated seller that then now just gets rid of that deal or works with someone else to get that deal across the finish line. So those are two big reasons. My time, money, and energy is better spent doing buyer activities, finding deals to actually buy and own, and then not working on other people's timelines or raising money, right? Yeah. So spending my time and energy on finding deals to buy and raising money, that is a better use of my time as a buy and hold investor than putting deals directly under contract with sellers or agents. And then secondarily, I do not like to work on other people's timelines. One thing I will caveat is, yes, some of the best freaking deals that you buy are going to be the ones that you put directly under contract with sellers or agents. It's not only because of the assignment fees like that you would avoid, but because if you are very intentional about what you are looking to buy in a specific market, you can sniper certain properties. And I still sometimes do that. Part of it is I enjoy it. Like I really genuinely enjoy putting some of these deals under contract. I love that piece of it. And part of it is there's like only so many deals that a wholesaler could put under contract that would make sense for my buy box. For example, I was able to buy a $2 million mansion in San Diego, which $2 million in San Diego is not a lot, but it's 6,500 square foot, huge property. And I was able to structure this deal because I was direct with the seller and agent on this one. I was able to structure it where I literally paid the seller $0. The agent got less than 1% commission fee on that. And actually, the seller ended up paying me when I bought this property because he couldn't pay his half of the agent commission. So he ended up paying me after the fact to be able to buy this property from him because this was a pre-foreclosure. He was just about to not be able to make the next month's payment. And he knew what was going to happen with his VA loan. If he got foreclosed on, he was going to ruin his credit. He was going to lose his ability to use the VA loan again. So I structured it in a way that, hey, I'm going to buy this property. I'm sorry, you're not going to get anything out of it in this scenario because you're about to lose it for nothing anyway. I will cover my portion. I'll even cover your portion of the agent commission. But you have to pay me back over time, on your piece that I'm covering for you. And I was able to take it over with all of his furnishings and everything. And what he needed was, I don't want to wreck my credit. I don't want to lose my ability to use my VA loan at some point in the future. He already had another property that I was living in, so he didn't need to use it in the near future. So he was able to set up a balloon a decade, 12 years out. So he would get his VA loan 12 years after I bought it. So you don't really, like a wholesaler can't really do that very well for you because those are not like conducive deals to the majority of buyers. They're looking at deals in a certain frame. So if you're looking for something crazy like that or something very specific, you might have to be the one to go direct to the seller agent. And because if you are a really solid buyer or negotiator, you can probably structure these deals. If you're going less on volume and you're being very targeted on the deals you're going for specifically, it might work to your advantage to go directly to the seller agent. However, if your main goal is to buy and hold as many properties as possible, on the path of financial freedom and you want to do that efficiently, then buying deals from wholesalers is always the way to go. If you have a few deals you're trying to sniper, like every once in a while I do, yeah, then it makes sense to go direct with sellers and agents. Because I honestly think there are three main buckets to buying deals. You go direct to sellers and agents, whether it's on or off market. You joint venture with people who maybe have a motivated seller, but they don't know how to put it under contract, or you just buy deals from wholesalers. When I look back in hindsight, the majority of my great deals have come from, well, the majority of my deals have come from buying deals from wholesalers. That's why I share that transparently. In the time that I've saved doing my direct acquisitions, I've been able to build a massive list of capital partners and then raise the money to buy my deals and just to buy deals from other people and build my skill set of analyzing these deals. So that being said, well, I'm telling you to go buy deals from wholesalers. Well, how are you going to do that? Well, if you're in sub 2, well, you have the best creative finance real estate investment community there is. Thank you, Pace Morby, for creating this. My mentor, life-changing for me. And he's created this amazing community. Whether you're in the paid sub 2 community or the free one, people are quite literally putting deals out there all the freaking time for you to be able to buy them. If you are a super investor, you have superpowers. One of them being the Super Deals database. It's like Zillow for creative deals. You can literally just go in and say, okay, I want to buy this deal in Texas. I want to buy this $331,000 property. Entry fee is $27,500. It's a 4-bed, 2-bath property, 3% interest rate. I want to take over this property. Or you say, you can go filter the different markets or whatever. You can do whatever. You can filter these things. Shoot. I might buy this deal right now. Just looking at it, this might be one we analyze next week if it's available. I don't like this interest rate, but $400,000 property in Atlanta, larger property, seller carryback, which means seller financing, which means I can renegotiate the 7%. And it says no entry fee. So I don't know what the heck's going on here. Maybe it's a Morby method. If it says seller carryback, it might be a Morby method. Yep, buyer originates new loan. So it's a Morby method deal. Whatever. This is one of the many things. I work with a variety of wholesalers that do high volume in our sub 2 community to then be able to get these deals and present them to more buyers, especially my super investors. There's 60 plus super investors that are actual buyers that are going to get deals done. These are the types of tools that you want. That is what super investors is for. Reach out to me and we'll see if you're a great fit for the community. All right. I think I've said enough about why I prefer buying deals directly from wholesalers instead of going direct to agents and sellers. So why I prefer buying deals from wholesalers instead of going directly to sellers and agents. There are pros and cons to each side, but if you are a buy and hold real estate investor, I hope the main takeaway for you is the reason why I prefer buying deals from wholesalers is because my time is better spent on finding great deals to buy and raising money to buy those deals, as opposed to working with trying to filter through the hundreds of potential sellers to then find the few that are motivated, to structure a few that then may or may not actually be deals that fit within my buy box. All right. So with that, let's see if there's any comments on this. Okay. More efficient, more smart. Absolutely. How do I find and engage with contracting cities I don't reside in on your CoLiving? When dealing with wholesalers, how are you not getting, okay, let's see. When dealing with wholesalers, how are you not getting pressured on time? It seems all the wholesalers I'm talking to barely give me time to analyze. They all seem to have severe timelines or short timelines. Well, I don't care. I'm the buyer. They don't make money unless I pay them, right? So if they don't have a reasonable timeline for me to be able to analyze this deal and do my due diligence, then I'm not going to force myself. Once again, I hate the urgency. So I'm not going to force myself to get things done on their timeline. So if they did not do a good enough job, if they did not set a far enough closing date and then a reasonable enough due diligence period, well, that's on them. That's not my fault. That's up to them to negotiate these deals better. And I would quite literally tell them, hey, I need X number of days to be able to look at these deals. I mean, honestly, you should be pretty good at looking at these deals within the same day, be able to analyze and provide feedback. In my opinion, you probably need to get a little bit better at analyzing deals. However, it's up to the wholesalers to make these deals, to structure these deals in such a way that is conducive to the end buyer. The problem with most wholesalers, one thing you will learn if you are a wholesaler is the majority of people that put properties under contract are not able to actually dispo them. So for every 10 deals they put under contract, usually like 50% of those never end up getting sold. So they just now wasted their time, money, and energy getting that deal under contract, all of that work, whatever, maybe even lost their EMD to then not even be able to sell that property and make their assignment fee. Like That's up to them to do a better job as wholesalers to structure it in such a way that makes sense for the end buyer. Because the same way that I buy the majority of my deals from wholesalers, well, wholesalers, every single wholesaler needs to sell their deal to an end buyer. Otherwise, they make no money. Wholesalers make no money putting deals under contract. They make money selling them to end buyers. So if they're not providing a great product, well, it's not surprising that they're unable to then get these deals sold. And one of that is not applying an insane amount of pressure to your buyers. However, if it is a short time frame, get fast at analyzing deals. Sometimes you have to take risk and put a property under contract that may or may not make sense once you do the due diligence and send your contractors out. There's always the risk, right, with investing. It's up to you if you want to put EMD down, like your earnest money deposit down, before you're able to buy these deals, or like get a contractor in there, do your full due diligence. It's ultimately up to you and your risk tolerance. But if wholesalers are pressuring you, well, what's the freaking pressure? I don't care that their deal's not going to, like, if they messed up their timeline, that's on them. That's not on me. Once again, I said I hate urgency. Just because they failed to plan or put a property under contract effectively does not mean that that urgency then goes on to me, right? Like, that's why I already hated wholesaling. So why am I going to apply that same pressure as a buyer? Hopefully that helps. Yes, other questions. I will answer that question when it's more relevant to this. Okay. So let's see. I don't think I see anything on Instagram. All right, so let's move on to the next question. It is, what is the minimum cash flow that I need to buy a deal? So let me explain two quick concepts real fast. So there is cash flow, which is your monthly profit that you're anticipating on a property. So your income, like the rental income minus the expenses, minus the money you're setting aside for reserves, which include vacancies, maintenance, all that kind of stuff. So your cash flow is the profit. Income minus expenses minus reserves is your cash flow. That number, if it's a long-term rental, most people are willing to buy long-term rentals that generate at least $100 a month of cash flow. For me, deals at that low of cash flow no longer make sense, but it's hard to get much more than that unless you are doing something like a short-term rental, a mid-term rental, or co-living, my favorite of all those management strategies. So for me, for my co-living rentals, I don't buy a single property that generates less than $1,000 a month of cash flow. And then a big part of that is, not only is it not worth my time to do all this work for $100 a month, but if I'm raising money to buy these deals and I'm paying a private money lender a fixed interest rate, or a private money partner splitting the ownership with them, including the cash flow. Well, if it's less than $1,000, what are we really splitting? If it's $200, $300, what are we each doing all this work and them investing to then split $150? Like, that doesn't make a lot of sense. So my criteria personally is I do not do deals that generate less than $1,000 a month of cash flow. Big reason for that is it's really not worth my time to do anything less than that. And secondarily, if I'm raising the money, which I always do on my deals, well, I've got to pay a private money lender or split some of that with a private money partner. If it's less than $1,000, there's not enough meat on the bones, in my opinion, to then make the deal worthwhile. Depending on where you're at in your investing journey, you might have a different cash flow goal. I said all that for cash flow, but cash flow cannot be put in a silo. Cash flow needs to be complemented by another metric called cash on cash return, which cash on cash return is, what is your annual cash flow, right? If you make $1,000 a month or $12,000 annual cash flow, right? 1,000 times 12 for the year, $12,000 a month of cash flow. Well, or $12,000 a year for cash flow. You have to divide that by your entry costs, how much money you have to put into the deal to acquire it, renovate it, furnish it, reserves, whatever. You have to take your annual cash flow and divide it by the entry cost, what it costs to get into the deal and get your property operational. You have to account for that. Otherwise, the cash flow in a silo, like in a vacuum, doesn't mean a lot. Because if I put in $100,000 to buy a deal, or I put in $10,000, or I put $1 million to get $12,000 a year of cash flow, that makes a huge difference. I don't know what those numbers are specifically, but that is why the cash on cash return, your annual cash flow divided by your entry cost, is so important to understand. That metric is so massive. And I would say that is a better metric for most people. Like I said, cash flow, you have to understand your cash flow metrics. You have to understand your cash on cash return. What are the minimums that you're willing to do? Because cash flow, there needs to be enough meat on the bones to make it worthwhile for everyone involved. But then you need to understand your cash on cash return. So then you understand how hard is the money working for me that I'm investing? If I'm investing $10,000 versus $100,000 versus $1 million to generate that $12,000 of annual cash flow, you need to understand, like, the less you put in to get the higher cash flow, the harder your money is working for you. That's very imperative. I can actually show you that, and then I will show you my specific different requirements for long-term, mid-term, short-term, and co-living. And I'm almost exclusively only doing co-living deals now because those just make the most sense logically. It's just an integral part of my super investor blueprint. So let me show you that, and then I will actually be able to touch base on some of the other questions that were asked. So let me screen share. All right, cool. So when you look at my requirements, and this is the Super Investor Creative Finance Calculator. So this is a paid calculator that is exclusively offered to my super investors. You join, you get lifetime access calculator. I have a free version of this calculator in the super investors or the the real estate community. You're more than welcome to download it. It is not nearly as robust as this one, but it's a solid calculator nonetheless. Can handle traditional, creative, all types of deal analysis. It doesn't have as many management strategies, the automated negotiation information. It doesn't have long-term analysis, or if you're raising money, spit all this stuff out. If you're raising money from a PML or a PMP, you put this in your presentations. It doesn't have all of those automations, especially the capital raising piece, but it's a great calculator to be able to analyze deals. It's actually the number one calculator. Me and one of my mentors, Jerry Norton, are quite literally fighting for that number one spot of best free calculators when you Google them. All right. So with all that being said, you can go grab a free copy of the calculator in Wealth to Real Estate, or if you're interested in being a super investor, reach out to me directly. We'll see if you're a good fit for it. And then you will get you'll get lifetime access to this calculator and all the updates that I provide, which we're doing a huge new revamp coming up soon. So minimum cash flow that I need to buy. So for a long-term rental, my minimum requirements are $100 a month and 10% cash on cash return. However, for the most part, that doesn't make sense for me nonetheless. Like if I'm not generating, you have to be realistic. If your goal is 50% cash on cash return, well, you're more than likely not ever going to find that creative, traditional, whatever for a long-term rental, unless you're buying a property that has really ridiculous rent. Well, that's not really possible. There's only a limit to how much the rent can be. Has really, really low, it's a really cheap property worth very little, and then the monthly payments are very little. That's really the big arbitrage you're going to do there. And I don't want to own a portfolio of $50,000 properties that generate me $500 a month as long-term rentals. Why? I don't want to do that when I can buy bigger, better properties in nicer locations that generate me higher cash flow, generate me better ownership benefits, better tax benefits, better debt pay down. There's more of these available, and there's easier, bigger markets. For me to get a contractor in Atlanta is much easier than some small freaking town on the outskirts of, I don't even know, just tiny little markets. And that's where co-living allows me to get the best of both worlds. I'm able to get much higher cash flow. Get much higher cash flow. Let's see if I can move myself. So get much higher cash flow as a co-living rental, and my cash on cash return is higher, which means that I can also raise money more easily through capital partners. So basically, the higher your cash flow and the higher your cash on cash return, the better your deal is, the more people want to either fund you, they feel more confident in you if they're lending to you as a private money lender, or as a private money partner. When you split those ownership benefits, it makes more sense for them. So my pad split or co-living cash on cash or cash flow that I look for is at least $1,000 a month, and the cash on cash return that I look for is at least 15% cash on cash return. I have the same requirements for midterm rentals and a little bit higher for short-term rentals, because I think short-term rentals are more volatile. Oh, so you can't see it right now, but if I went nope. If I went like this, you can kind of see it. No, you still can't see it. Whatever, who cares? Short-term rentals, I have a cash flow goal of $1,000, but I want a higher cash on cash return because I think it's more risk. The more risk, the higher the returns you want. That's why for a long-term rental, I'm willing to do a 10% cash on cash return. However, for a co-living, which I think is more risky than a long-term rental, I think everyone would agree with that. However, there's much more benefits overall. So I want much higher cash flow, and I want much higher cash on cash return of 15% here to be able to move forward with a co-living rental. This number fluctuates. I would say honestly, it's between 10 to 15%. As long as I'm hitting my cash flow goal of over $1,000 a month, and it's still a solid deal in regards to cash flow, but then has really great ownership benefits as well. That's really what I'm looking for. It's not just, when you're talking about ownership of great properties, you're not just talking about the cash flow. A lot of people get hyper focused on just the cash flow, and that is imperative, right? If you have a private money lender, you need cash flow to be able to pay that private money lender their interest. Or if you have a private money partner, yes, they're going to want cash flow in exchange for the money they're investing. They want some of that money back in terms of cash flow. But if you are buying these properties, you're owning them, and you're bringing in a private money partner, well, not only do they get, let's zoom in a little bit. Not only do they get, for this example, they're putting in $89,000, almost $90,000. And in this instance, let's say it's a 50-50 split. They're not only getting 50% of the cash flow, they're also getting 50% of the ownership. So not only are they getting for this $89,000, and they're splitting right? So the total cash flow on this property is $19,895. Well, they're getting their 50% of that. They're getting $9,947 of cash flow, giving them an 11.1% cash on cash return. Not only are they getting that, but as an owner with you, they also get the benefit of the debt. You guys are paying down the debt, which is adding to your equity. They get a benefit of that. Your properties are appreciating in value. As an owner, they get the benefits of that. As a 50% owner, they get 50% of those benefits. The tax benefits, well, you're paying interest and your properties get depreciation. Those are tax benefits that they also get ownership benefits to. So when you look at the total return on this investment, it's not just the $9,000 of cash flow they're getting for the year, $9,947 of cash flow, or the 11.1% cash on cash return. Well, they're also an owner. They get ownership benefits. So their total return on investment is 23.1% ROI, right? And in my opinion, that's a really freaking high ROI and a high cash on cash return. Depending on where you're at in your investing journey, you might need to offer that 50-50 split for someone to partner with you and fund that deal. For me, my partners get because the more proven an operator you are, the more you pay people out, the more you take care of your partners, the longer you've been doing it, the more knowledgeable you are on these, deal analysis, structuring, operations, the less you offer, the less you can offer and still have people partner with you, because you are a more proven operator. You're a lower risk to them. Not only is the deal better, but you're also a lower risk to them. And so maybe it would be a 40% split or whatever the actual split ends up being. And they're getting a slightly lower cash on cash return and return on investment. Honestly, these are solid. Still almost 9% cash on cash return, 18.5% return on investment. They get 40% ownership of the property, because this deal is a great deal overall from both and these are fake numbers, right? I don't know anything about this deal, but the cash on cash return is so high, the cash flow is so high, and the ownership benefits of this property are so high, they're getting a massive overall return on this. So when you ask me what is the minimum amount of cash flow I need to buy a deal, it depends on the management strategy. For long-term rentals, it needs to be over $100. But honestly, anything under, if I'm not taking home at least $500 per month per property, it doesn't really make a lot of sense for me unless there's a phenomenal ownership benefit side. Like that multi-million-dollar property in San Diego, I get little to no cash flow because I was able to get into it for very little money, virtually nothing. I have almost infinite returns. And because it's such a big, beautiful property that is in a great market, I get tons of wealth benefits. So even if I only make $1,000 for the year on cash flow, I'm making $50,000+ a year in ownership benefits. So it really depends on the deal and what you're looking for. But depending on your minimum cash flow requirement is going to depend on the strategy that you implement. Like I said, for me, I don't want any less than $500 a month of cash flow, regardless of the strategy. And that's after paying my capital partners. So to make sure that's possible, I need to make sure that my properties, especially co-living or pad split, the main thing that I do is at least $1,000 cash flow. And then my cash on cash return needs to be at least 10% or higher, so that my partners are getting, my partners are also getting great returns for the money that they're investing. The higher cash on cash return, the harder your money is working for you. Whatever you guys invest into the deal, that means you're getting a larger return in regards to cash flow. When you now combine that with ownership benefits, right, then it's even better returns for your partners and for you as well. So what I mean to say is cash flow is important, and it's going to depend on your management strategy. Your cash on cash return is very important because it talks about how hard is the money you guys have invested? How hard is it working for you? How much annual cash flow are you getting relative to the entry cost they had to put in to get into the deal? But then there's also the ownership benefits, which is part of the total return on investment that I think also needs to be accounted for, because real estate is not just a cash flow game. You're also getting the benefits of ownership. That's why it's so imperative to understand how to analyze deals, both as the buyer, the lender. I mean, I think wholesalers should do it as well, but I don't think the majority of wholesalers are getting this nitty gritty with their analysis. If they did, they might sell more deals because they could articulate it better, but that's not my job. All right. With that being said, depends on your management strategy. I explained the variety of cash flow goals and why cash flow is in a silo does not matter, because whether if I'm getting $1,000 a month or $12,000 for the year, it depends. If I have to put in $10,000, $100,000, or $1 million to get that, that's your cash on cash return. It's telling you how much are you getting in return to the money you had to invest. So that's really important. Not just cash flow, but also your cash on cash return. And then it's important to understand also the ownership benefits involved with real estate investing, not just the cash flow. The next question, can I break down my entry fees for buying an investment? Does it cover acquisition? Okay, this is perfect. This is also in the calculator. So these are my entry costs that I account for on every single deal. I account for the down payment to the seller. So this $53,327. You're going to notice that's different than what we have is the $89,000 here, because on the Super Creative Finance calculator, you can also choose the management strategy. And depending on which one you choose, it's going to give you the entry. It's going to take whatever the standalone entry is for the property and then add whatever additional entry costs there are relative to the management strategy. So if it's a co-living room where you're going to need to build out more rooms, more than likely, and you're going to need to furnish those rooms, so there's a larger entry cost. If it's short midterm rental, you're going to need furnishings for that property. If it's a short-term rental, you're going to need even more furnishings for that property. It's going to be even nicer furnishings, maybe more remodeling. So depending on what management strategy you select, that's the number that goes into the capital raising piece, or which one you select. But for every single deal, there is, let's see how many I have. 1, 2, 3, 4, 5, 6, 7, 8, 9. I have 9 different entry costs for the most part. Those are my buckets, but I bucket those into 3 main categories: acquisition costs, renovations and furnishing costs, whatever it costs to get the property ready for your management strategy, and then reserves for the property. So what I lump into your acquisition is if there's a down payment to the seller, that's accounted for here. If there's arrears or liens, you have to pay back a seller, or you have to pay catch a seller's mortgage up, or you have to pay off liens to acquire the deal. That needs to be accounted for. Even if it's not going to the seller directly, that needs to be accounted for because that needs to get paid. If there's an agent involved and you're paying an agent commission, that needs to be accounted for. You need to renovate the property just to get it like rent ready. That's accounted for here. There's more renovations needed for the other strategies. Well, that's fine. You account for that in the other areas. Closing costs. Well, when you're buying the deal, you need to account for those closing costs. I account for this separate category, which a lot of people include in their admin. I have it separate because these admin/reimbursement costs are, I've got to pay a transaction coordinator. Usually I'm paying them a deposit up front. I have to form the LLC. Usually that's happening before my capital partner puts their money in the deal, and I'm paying for the inspection out of pocket. These are part of the closing costs, but if I'm raising capital for these deals, I need to get paid back for these. It's nicer and easier to just split this amount up front and say, okay, I need to get paid back for these 3 things at closing for my capital partner and have that here. A lot of people just lump that in their closing costs, which is not inaccurate. It's just, for me, it's easier to see it separate because I know I need to get reimbursed for that, because I'm probably paying those, or I am paying those costs before closing, and I'll get reimbursed that when my capital partner funds the remainder of the closing costs. If there's a wholesaler involved, then there's an assignment fee that you're paying the wholesaler. If you are accounting for an acquisition fee, this is going to you as the buyer, then you need to account for what that amount is. I would say for the majority, you should not be getting an acquisition fee unless you're getting an incredibly phenomenal deal, or you are providing additional services that you're not charging your capital partners for. For example, these acquisition fees cover the costs for my asset manager, which then oversees all of our portfolio that they get to benefit from, includes our property management, and why we're able to do a lower property management cost for our partners than just paying someone else like a third-party property management company. They get to benefit from my CFO, my COO, the VAs that we have in the business to help handle a lot of our guest communications and administrative. That's what this is going towards. For the majority of people, you have little to no overhead. You should not be charging an acquisition fee unless maybe the deal is so phenomenal. it really depends. It's up to you and it depends on your deal terms. But adding more towards your entry cost is going to diminish the returns on your deal, making it harder for you to raise capital and result in a higher entry cost, which you may not be able to raise the capital for. And the last thing, one of the most important, is carrying costs. These are the reserves for your property. These are reserves for your property. So then when you buy the property, where you're going to have to, it's not going to be rented right away. So you're going to need to, if you're renovating the property, you're going to need to pay the mortgage. During that time, you need to pay utilities, any other costs associated during that period. You're going to have to pay that. You need to account for that here. And then if you're going to have additional reserves that you're raising for, let's say, maintenance and capital expenditure in the future, these carrying costs / reserves should be accounted for here as well. And rule of thumb, we put at least 3 months typically of the expenses, at least the debt payments at minimum. And then in addition to that, I recommend raising some reserves for the property as well, so that if something goes wrong early into the investment, like you're setting aside maintenance and capital expenditures and reserves, but if something goes wrong early, you're not going to have a big amount in there. It's good to at least have $5,000, $10,000, $15,000 for your property ready to go, just in case something comes up that you weren't anticipating, or a renovation costs more or whatever. It's better to have that ready to go than to ask your capital partners after closing within months to put in more money in the deal. All right, so those are the entry costs, right? In reality, it's 3 buckets: acquisitions, rehab and furnishings, and reserves. However, there's multiple parts that are included in there. And depending on the management strategy, there's going to be additional costs. So this renovation and furnishing cost is added to the renovations and furnishing costs you saw here, right? It's adding to that for the co-living management strategy. If you're going short-term rentals or midterm rentals, either one, you have furnishing costs. Well, that you need to account for those as well as part of your entry costs. And that's why there's a new total entry depending on the management strategy on the Super Creative Finance Calculator. So you'll see that's why they're higher amounts, different amounts. And that's why it's important to have higher cash flow. If you're paying more, if you need more entry, you're paying more, you need more cash flow to then get the same or higher cash on cash return. All right, hopefully that answers that question. Let me see if there's any. So someone said, if you go the paid calculator, does it come with a training video on how you can underwrite a small multifamily like 10 unit? Not specifically, because that's a commercial property that's different. This calculator is best for residential real estate, especially going the creative finance route. If it's a 10 unit that's seller finance, that'd be pretty straightforward. But understand the subject to side of it will not work very well. Like, you can't really subject to a commercial loan. There's a lot more risk involved, and I'm not going to get into that in this video, like this training. But you can basically use this calculator for new loans, cash deals, seller finance deals, subject to deals, or hybrid, like subject to seller finance combined. This can work for all of that. That's one of the revamps. I'm putting this all in one with like a few clicks of a button. You can just change how this calculator is utilized, what is the debt structure for it, or if it's just a cash purchase. You can base your 10 unit information here. Like, I've got up to 4 different units you can add here. Just understand that 10 unit, it just depends on the unit mix and how much rental income and what each one's going for. So that's a very specific question. Let's talk about that one later. However, you can kind of do that. There's not a training video specifically on a 10 unit because it depends on how you're going to acquire the deal. Are you doing a bunch of value add? Are you buying it as is? It's cash flowing. It really depends on the deal itself. All right. The last question for today. What is my rule of thumb for an assignment fee? I've heard $1K assignment fee for every $100 of rental income. Okay, so this is kind of something I've seen thrown around in sub 2 for years. I've not challenged it. It depends on a lot of variables, because when you're saying $100 of rental income, I think they mean cash flow. What strategy are you talking about? Are you talking about like as a long-term rental, as a co-living rental? It really depends on what you're talking about. I don't really care for rule of thumbs. I mean, your rule of thumb should be the property should cash flow at minimum what you're looking for your overall cash flow goal. However, the assignment fee, in my opinion, is not like a rule of thumb thing. For every $100 of long-term rental income, paying $1,000 assignment fee, well, so it needs to generate $1,000 a month of long-term rental cash flow to pay someone a $10,000 wholesaler assignment fee. Well, you're probably never going to find that. Property that's generating $1,000 a month of long-term rental cash flow is not going to be sold for $10,000 assignment fee. It's going to be sold for much more. So it's one thing to say, oh, I have this rule of thumb, I have these numbers on a spreadsheet, this is what I can offer. Well, if it's a phenomenal deal like that, someone else is going to buy that immediately, or the wholesaler is going to structure it so they're making a lot more than that. Like, I don't think these rules of thumb work very well. What I think does work really well is understanding cash flow goals and your cash on cash return requirements. So I don't really care what I pay a wholesaler. I tell wholesalers, I don't really care what you're making. I will pay you whatever, as long as I get my returns that I want on this deal. It's up to you to understand what are those returns that you want, base them on your cash on cash return. So for example, on this deal, let's say it's $388 a month of cash flow, but it's a 8.7% cash on cash return. This wouldn't be a deal for me because I'm not hitting my 10% cash on cash return. But in theory, this person's rule of thumb would be, okay, well, I'll pay you $3,000 to $4,000 of assignment fee because I'm making $300 to $400 of cash flow. So that's what I'll pay you. Well, I wouldn't go based off that. I think people would buy this deal potentially, depending on what their goals are. What I would say is I'm looking for my 10% cash on cash return. So what assignment fee or what other negotiations could be done first? And then last is the assignment. For me, I'd rather have the wholesaler working on my team. I'm not trying to nickel and dime the wholesaler. I'm trying to restructure this deal to make it so that it works for my investment criteria, and it works for the wholesaler to want to move forward with me as the buyer, and it works for the seller because the terms have to make sense for them. So you have to understand where is the most flexibility on this deal. Well, maybe the seller is getting $24,000 down payment, and you negotiate a couple $1,000s off there, and that's how this deal ends up making sense. So let's say it's $20,000 instead. Well, the cash flow is the same, but your cash on cash return, okay, it went up a little bit. It's still not there. What I would do is I would see at what dollar amount, what difference does it then make sense, and then try to back into that number. So let's say 15,000. 9%. All right. So you're going to need either more cash flow or you're going to need a much lower entry cost pretty much on this deal. So let's go. I mean, we'll go all the way to 5,000. I mean, that's taking it from, oops. That's taking it. That's $19,000 difference. Okay. You're still not even at 10%. So you basically go to zero here. Remember, just because I put this in a spreadsheet does not mean the seller is going to be willing to do this. Right? So don't get that twisted. So even now, okay, we're like pretty close at 9.9. So if we got basically 24,000, so I'm going to put this back here. I'm going to put the 24,000 back. So basically we would need approximately $25,000 off this entire deal to then make it hit your long-term cash on cash return goals. Okay. So if it was 24,000 was 9.9, 25% or $25,000 down, removed from the entry cost would then get you to that, I would assume. However, it does not all need to come from the seller. It can come really, the real negotiations are, is that going to come from the seller, the agent, the wholesaler? Because if you got to renovate the property, you got to renovate the property. If you got to pay closing costs, you got to pay that. If you need some carrying costs for reserves on the property, you have to do that. So really between the 24,000 to the seller, 6,000 to the agent, and 25,000 or 10,000 to the wholesaler, that $40,000, well, some way, somehow, $25,000 is going to have to be removed for this deal to work for you. I think if that is your goal, that's your criteria. I don't think that's going to be very feasible. Or if you can present it to the wholesaler, I think they can reduce it a little bit and get it sold to someone else. You can tell them, hey, for this to work for me, this is the cash flow I'm seeing. This is the cash on cash return that I'm seeing. I need at least a 10% cash on cash return for a deal like this to work for me. For the $40K entry cost between the seller, the agent, and your assignment fee, I'm going to need $25,000 of that removed. If that is not possible, no worries. Like, I'm not saying it's got to come from your assignment fee or all of it's, you get no assignment fee. However, if that's possible, if we can get $25,000 off the entry cost, I can be your buyer. If not, no worries. I understand. Like, that's really up to you. Understand that the more that you ask them to reduce, the more likely they are to just sell to someone else or not even try to renegotiate and just sell it. So it's really important that your numbers on a spreadsheet make sense for your investment criteria, but also understand the more that you want, the better returns that you want, the less likely it is for you to close on deals. That's why the long-term rental route was really hard, because no matter how much cash flow you make, even on this almost $400 and your goal is 100, it's still really tough to get a high cash on cash return on those deals. when you're talking about this co-living rental where you're making a lot more cash flow, even though your entry is, over $35,000 more than it was going to be as a long-term rental, because the cash flow is so much higher and your cash on cash return is so much higher, this deal could work for you. I'm not saying so then it's up to you to determine, am I willing to pay the wholesaler $10,000 for a deal that doesn't necessarily make phenomenal sense as a long-term rental, but it does make phenomenal sense as a co-living rental? It's up to you to decide, is that what you're willing to do or not? That's what I can say. It's less about rules of thumb. You've heard $1,000 for every $100 of rental income as a long-term rental. It's really dependent on what is your buy box. Are these deals fitting within your buy box? What is your investment criteria? And do you think it's reasonable? If you're telling wholesalers all day, every day, this doesn't work, this doesn't work, this doesn't work, at a certain point, you're gonna have to say either my investment criteria has to adjust so I can buy more deals, or I just understand that I'm only gonna buy these home run deals. I'm not gonna be able to buy I'm not going to be able to buy very many, but the few that I do buy, I'll be able to buy some of the best deals. It really depends on what your goal is, how quickly you're looking to scale, and what your investment criteria is, your risk tolerance, all of that. So it's very custom. That's why these rules of thumb and all that, I'm not a huge fan of it. Base your investment decisions based on your buy box, your investment criteria, your risk tolerance, and are you getting the returns that you want? And then is it reasonable to actually get these returns and find deals that make sense for that? What a lot of people realize is they have these crazy restrictive investment criteria. They have these crazy buy boxes, and there's a reason why years later they have virtually no deals to actually buy. They have these crazy investment criteria that are not feasible. I think, people hear too much about this person, this is their buy box, so I'm going to copy this exact buy box. They don't even know if that person's actually buying deals, but they've seen someone post it. Say regurgitating the same information over and over again, where it's going to be very custom and dependent on you, on your buy box, your investment criteria, your risk tolerance, the scalability you're looking to do, and are you actually getting deals that are coming your way or that you're finding that actually hit this criteria? That's ultimately up to you to figure out. I teach that in Super Investors. That's ultimately up to you guys to figure out what is it that makes sense for you. Cool. So in total, we've talked about a lot in this. We've talked about why I prefer buying deals from wholesalers instead of going directly to sellers and agents, really highlighting that I do go sometimes directly to sellers and agents. I just don't think it's the most effective use of my time, money, and energy. When my goal is to buy and hold more real estate, my job is to find more deals to buy and raise money to buy those deals, not spend all this time, money, and energy on directly finding, directly going to sellers and agents. Does not mean I do none of it. It just means it's not where the majority of my time and energy is going towards. And I don't like working on the sellers or agents' timelines, the urgency that's required from going direct, as opposed to just buying deals already under contract. Secondarily, we talked about the minimum cash flow I need to buy a deal. The minimum cash flow that I need depends on the management strategy that I'm implementing. And more important than just the minimum cash flow of $100 or $1,000 a month, it's really, what is my cash on cash return, right? Making that cash flow relative to the entry cost, which then tells me how hard is my money working for me. You asked me to break down my entry fees on buying an investment. What does it all cover? When my 9 categories account for, basically I have 3 buckets. The acquisition cost, what does it cost to get into the deal? The renovation/rent ready cost, what does it cost to renovate the property, furnish it, whatever it is for the management strategy, plus my reserves/carrying costs on that property. Those are the 3 main buckets, and I have 9 subcategories that those fall into. And then what is my rule of thumb for wholesaler assignment fees? I don't have rules of thumb. I think I dominate. I work much better than most as a buyer because I'm not here to base things off rules of thumb. I'm spending the time and energy on analyzing these deals. I'm not spending time and energy going direct to sellers and agents. I'm spending time and energy on analyzing deals, getting very good at that, then being able to quickly determine, does this hit the cash flow and cash on cash return goals that I am looking for? Not like based on my investment criteria, my buy box, my risk tolerance, my scalability goals, and my am I getting deals, right? It's a feedback loop. Am I getting deals that fit, or do I need to adjust somewhere? So that we've answered a lot on this training. Hopefully this was super valuable for a lot of you guys. I appreciate you guys. I will see you next week. I do go live every single week. Actually, next week I will not be going live because I will be at a conference. So I will not be going live next week. I'll be flying back. But virtually every single Wednesday I go live answering you guys questions, helping you analyze deals, and whatever you guys need to help you on your investing journey. If you have not already signed up for the free Wealth through Real Estate community, you are massively missing out. Provide free courses, trainings, tools, resources, all this good stuff in there. We have a community of over 1,100 members, all looking to do the same things. Become wealthy through real estate, whether they're wholesalers, bird doggers, buy and hold investors, lenders, all of that stuff, they're in there. So I'll drop the link one more time for the Wealth through Real Estate community. And if you're interested in scaling your portfolio more effectively to financial freedom, that is what Super Investors is for. We specialize in buying creatively financed deals, mastering deal analysis, raising money for those deals, and then the systems and operations that you need for your properties and for your business so that you can actually scale. So if that's something you're interested in, you can go sign up directly on school. I don't recommend it. Reach out to me first. Let's have an interview. Let's make sure it's the right fit before you sign up for something like that. All right, y'all. Thank you. Have a phenomenal rest of your week. Crush it on your goals.